Mr. Bogle, we spoke to you last year at the Morningstar conference about some of your expectations, return expectations for the stock market, and we have seen since then even continued run up in the market overall from year-ago levels. And you had, at the time, had pretty moderated expectations for the stock market. What would you say investors should have on their radars as far as return expectations today versus a year ago?
Well, let's first say nobody knows, but there are sound bases for realistic expectations about future market returns. Number one, the future returns in the bond market over a decade. Let's look a decade because there's no point in looking any shorter than that. The future returns for bonds is very heavily shaped by the current interest rate. And so if bonds are now yielding around 4.5%, some package of treasuries and corporates, that has a 90% correlation with the return you'll get in the next 10 years. That shouldn't be very surprising to anybody because bond returns are generated not by capital appreciation, but by interest coupons. So if you look for, say, 4.5% over the next decade as a realistic expectation, that would give you about a 60% profit, 60% total increase in capital. Now, let's go to the stock market. Well, here it's more complex, but the principles are the same. The dividend yield today is around 2.25%. From these levels of earnings, whatever they are, because there's a lot of cheating going on in corporate America about earnings, a lot of focus on operating earnings, which are, of course, higher than reported earnings, which have all those write-ups in them. But whatever it is, I think earnings might be able to grow from these levels way above the long-term norm, which is around 5%. To maybe 6 or 7%. Let's use 7 and say the investment return, that's the dividend yield, plus the earnings growth, might be as high as 8 or 9%. I look for price earnings multiples, which are the source of speculative return, which can add or detract from that investment return, as nobody knows what those PEs will do in the next decade. But I'd guess they'd come down a little bit, maybe taking that 8 or 9% return down to, say, 7%. So that would be my outlook for reasonable expectations for stocks in the next decade. So at 7%, as you well know, that will mean you'll get a 100% increase in your capital. So stocks should get the nod, but only if you can afford to fight your way through the turbulence that you will see in this next coming decade. And if it's not today, it's going to be tomorrow or a week from tomorrow or a month from tomorrow. And so you want to keep your behavioral negatives out of your investment program to the extent you can. And so while stocks I expect will do better, that's not guaranteed. And you need a little protection, a little anchor to windward, a little dry powder to keep you from making foolish mistakes along the way.